Hello and welcome to episode 4 of the Retirement Readiness series. My name is David Vigil. I am the principal of Vigil Wealth Services here, and I'm having a little technical difficulties. Get this out of the way. Tonight, I have a very special guest. Again, I'm your host, Mr. David Vigil, the principal at Vigil Wealth Services. I have Hobee Berman. He's the regional vice president of Midland National. And we are going to discuss how folks can save for retirement with a life insurance policy. These are things that most individuals don't know. So we want to get it out to the masses that this is a great little solution for folks who are the high wage earners, or just folks who want to save more and they're maxing out their 401ks, they're maxing out their IRAs if they're income eligible. There are other ways that you can even save more towards retirement. But without further ado, Mr. Hobee, how are you tonight, sir?
I'm doing well. Thank you for having me on.
Hey, thanks for joining. Let me try to move this around here. There we go. All right. So we're going to get into the presentation. I'm going to hand the reins off to Mr. Hobee, and we're going to discuss a Midland solution. Mr. Hobee.
Sounds good.
And again, this is who I am. I'm the principal of Vigil Wealth Services. I'll have all my contact information here for any questions that we didn't go over during the presentation. So, Hobee, we'll start with the screen here. So the accumulation phase. So I'll start. The accumulation phase is when you're, generally speaking, younger. You're saving towards retirement. You're investing. You're putting money into, if you have an employer-sponsored retirement plan, you have IRAs, and again, you're accumulating wealth for your retirement. And again, as it here is putting back enough to fund retirement, avoiding major economic setbacks, planning for the unexpected. Anything you want to add, Mr. Hobee?
Yeah. So I can't. If you would, David, I don't know if you can share the screen, but the slides aren't popping up yet. But to add to the accumulation phase, I think it's important for most people to be looking at diversification, not from just when we think of the traditional ways of, well, what type of risk am I taking? Am I using equities versus bonds, or am I using alternatives, non-correlated assets? Are we talking about real estate, gold, et cetera, all the different asset classes that are out there, but also tax, tax diversification. So in accumulation, I think so many people, they leave the tax talk out of the equation, and they're just so focused on, hey, I need to just put this money away. And they don't realize that, hey, the risk portion of it, or just putting the money aside, is only half the equation, because it's not just, what you have, it's what you keep, right? And so, right. That's where I think the IUL and Midland National, using a life insurance, product or life insurance tax shelter to help in the accumulation phase, is going to, help hedge your bets on, regardless of what, the government and the IRS makes a decision to do with taxes in the future. You're putting a hedge on that. In addition to that, access. When we all talk about accumulation as if, there are never any bumps in the road, both from health-wise or from employment, or our ability to be able to fund things like pandemic, which might, put a pause on things, or put us in a position to where we need to access these funds. And, accumulation is great using tax deferred and taxable investments, but, in times where you might need that money early, say pre-59 and a half, and if you don't have, one of your typical eligible reasons that you're able to take the money out without paying a penalty, the average person could be stuck with 20% mandatory withholdings. They could be, hit with, early withdrawal penalties, 10% from the feds, and additional percentages from the state that they may live in. So I think when talking accumulation, it's a broad topic, and it's something that I think it's multifaceted, and I think that's why, it's important to work with an advisor like yourself or others, David, is to, address not just the types of risk and the types of assets, but to be also talking about, what will taxes do to this money, and what happens if you have an issue with funding, or there's an early disability, or there is an early death in the family,
Right.
or from a wage earner, whether that's the either spouse, right, in today's dual income families.
Right.
So I think that accumulation is a broad topic, and there's a lot that goes into, I guess, that word or that
Right.
phase of life.
Right. And the 15.5, just to go back to that, that's from your qualified accounts, your IRAs, your 401ks, or your 403bs, employer-sponsored retirement plans. If you take money out of the employer-sponsored plan, they're required to withhold 20% to the federal government if you're taking a lump sum. And again, if it's before 15.5 and you don't qualify for one of the exemptions, you get the 10% penalty on top of the taxation if it's pre-tax. So life insurance, how would life insurance fit into a retirement plan? And retirement planning is my whole thing. That's why I'm doing this series here. So someone can go into my social media pages, they can start watching videos, get educated about the different ideas, different solutions. They may do it themselves, or they may engage a planner like myself to help them kind of put the pieces together. But again, life insurance, how would that fit into, I know it's different scenarios, single versus married, you need some protection for your wife or husband and family. But for retirement question, how would that look like?
Yeah, so specifically, just addressing the retirement piece and not addressing, being incapacitated pre-retirement or having an early death. So getting away from the insurance piece and talking more about the supplemental retirement income, right? We're driving and funding a vehicle like this, an insurance policy, so that you could take, retirement income in the future. I would say first, is, people retire at different ages. So for those folks who are highly compensated or who are business owners who may want to retire prior to 59.5, right?
Mm-hmm.
To your earlier point, this could bookend their retirement. It could be for early access to be able to live off of distributions from a life insurance prior to 59.5 without a penalty, right? Until they were able to access their qualified accounts. And then again, later in life, should they need a bump or additional income due to inflation, or possibly running out of money, things like that. Again, turning to the policy again to access funds for supplemental retirement income, both to increase their income or to replace missing income during that phase. So with an insurance policy, when you structure it as a non-MEC, the thing with it is that you're able to position it in a way where you can take withdrawals to basis, or you can take policy loans, and specifically zero cost policy loans, so that you're not paying any interest on those loans, and you're able to access that money tax advantaged or tax free, right? So not
Mm-hmm.
on your tax return, right? So not driving you into those higher tax brackets. So it puts you in a position to be able to fund the money into the plan over time, right? And then in the future, be able to access that money in a tax advantaged way, or tax-free way, so that you can, receive maybe a higher level of income without moving into some of those higher tax brackets, therefore giving you some control regardless of what the federal government decides to do with tax brackets in the future, right? I'll give you just a quick example, right? So if you have a client or an individual who were to come to you and they were to say, hey, when I'm retired, I need $200,000 of income on an annual basis, right?
Mm-hmm.
And so we need to put together a plan, David, to where when I get to retirement, based on certain assumptions that we can both agree upon and we believe are reasonable, I would like to receive $200,000 of income. So when you look at that from a tax standpoint, you say, okay, well, based on today's tax code, right? The first 100,000 in income, if you include the standard deduction, is in a 12% federal income tax bracket. And it's currently, based on the sunset provision in the Tax and Jobs Act, set to expire and go back to 15% after 2025.
25, yep.
So in our example, the first 100,000 married filing jointly, right? the client would pay 15% taxation on that income, or about $15,000. Now, if we stay with that, the second $100,000 that they were to receive, if it was coming from a taxable source, either things like IRAs or qualified plans or other taxable sources as income, would move to the next bracket, which post Tax and Jobs Act will be 25%, assuming there are no additional increases in the tax law. So on the first 100,000, right, I pay 15,000 in tax, but the second 100,000, I'm going to pay $25,000 in tax, in addition to whatever state income taxes, and those have brackets as well.
Right.
So by adding, the insurance policy for supplemental retirement income and being able to take these policy loans, these zero cost policy loans, and having that money come to me in a tax advantaged way, I'm able to say, well, you know what, David, from my overall plan, from the different assets that we've put together over the years, why don't we take the first 100,000, right, from a taxable source, and I'm happy to pay that lowest tax bracket, that 15%. But you know what, on that second 100,000, why don't we take it from a tax-free source, right, or a tax advantage source, where I can now skip out of paying taxes in that 25% legally, right, and get the second 100,000 without paying any income tax at all, therefore getting the entire 200,000 effectively at somewhere in the neighborhood of a 7.5%, federal income tax bracket, which is, it's not just helping me keep more of my money in retirement, but it's also positioning me to have more flexibility and control regardless of what happens with tax law changes in the future. And people can have all the discussion and fight back and forth whether their taxes are going up or down in the future. But I think, the conversation of, would you rather have more control of how the money is coming out from a tax standpoint, or less control regardless of the tax environment when you get to retirement or distribution? I think anyone you speak with is quite quickly going to tell you, I'd rather have more control, right, to be able to control the taxation so that I can keep more of my hard-earned money. And using a life insurance solution is going to put you in a position to have more flexibility and control through that tax advantage income from the plan.
Good. Yeah. So when I'm doing the retirement plan, I have my retirement income wheel, I call it. It looks very similar to an asset allocation wheel, where there's a slice of money coming to, so the goal, let's say, is 200,000 a year, for example. XYZ, the amount's going to come from your taxable account. This amount's going to come from your taxable IRA. This is going to come from your Roth if you have a life insurance policy. So that's how I position it when I do my retirement planning, is I create a solution based on how much they want or how much they're going to need, and from the different investment vehicles, put that together. But yeah, so let's dive into how would that work for folks. Let's say someone watches this webinar and says, great, this sounds like a great idea. Structuring it. I'll tell you how I personally structure it. And then again, Hobee, you're the gentleman with Midland. You can tell me if this is the right idea or not. I structured how long they're going to be in the accumulation phase until they retire. So let's say they're age 45, 55, whatever the case may be, they're going to retire at 67. That's the full retirement age. I structure the premium payments to be to 67, and then they stop while they're in retirement. And then they can, again, they have the will where they can take money from here. If they don't need to take money from the life insurance policy, fine. It'll be there just in case they need it. What would you think would be a way to structure something like that?
Yeah, so there are lots of different ways, and I think one of the big benefits to using the life insurance is the flexibility. So, when you think about funding retirement plans, specifically qualified plans, whether that's a Roth IRA, whether it's a traditional IRA or SEP, etc., one of the issues is that if I'm funding that and I'm in my working years and I have a down year, if I miss my opportunity to fund that, right? So if I'm not putting my $6,500 in this year and I only end up putting in $3,500 for whatever reason, life happens, right?
Right.
Then the next year I come back and say, I'm having a great year this year, and I want to not only do my 6,500, but I'd like to make up that 3,000 that I missed the year before. Right?
Not going to happen. Yeah.
That's not going to happen.
Right.
But with the life insurance solution, right, not only can we fund that, let's say if we set it up to take the $6,500 annually, and we only put in $3,500, the following year we have the ability to backfill for those missed contributions, right? Again, adding flexibility to our funding. And then when, to your point, when we get to retirement, we may be in a position where, hey, the assets that we have from our taxable, tax deferred and taxable sources and other investments is enough income, and maybe it's below a certain tax bracket that we're trying to stay away from, right? And so we don't need to take the money from the life insurance policy. Well, in that scenario, there is no RMD or force outs, right? So they don't have to worry about the possibility of receiving more income that's taxable that they don't want, that may be putting them in a tough tax situation on a go forward. That money can continue to be deferred and grow inside of the policy until such time they do need the money or want the money, right? And at that time, they're able to access that money tax advantage. Now, on the flip side of that, I know we're not necessarily talking about the insurance, but if we have an early onset dementia, if we have some kind of debilitating MS or Parkinson's, or someone's texting while driving and they hit me and put me in a wheelchair, right? And now I with these life insurance solutions with Midland National, there are living benefits through the chronic illness that would allow for me to access my death benefit while I'm alive, right? So now all of a sudden the money I've put in is leveraged up and it's provided to me tax free, right, from the death benefit while I'm living. So now I've got access to those funds, not just the cash that I put in, but also,
the death benefit.
Death benefit. Now I'm accessing that, tax advantage again while I'm alive, and that can, that can play a role in a lot of different situations. Well, what happens if I'm funding an IRA and funding a Roth IRA, and but I don't quite make it to retirement? Instead of 67, something happens to me at 62, and I'm unable to work. I'm not, it's not as if I passed away. I'm just not able to necessarily maybe earn. And now I'm not putting the money away that I thought I was going to, which I'm going to need to fund my retirement. Well, because of the life insurance solution, right, I've got a backstop or a hedge right now where I can access that death benefit. And then also, my underlying contributions stop and all expenses stop, right? So I'm able to now access that money, and it's a self-completing, so to speak, for lack of better terms, retirement plan.
Got it. So again, so inside the policy with Midland, they have a living benefit rider, I would assume, that if you were to have a terminal illness, it sounds like if you're capacitated, I don't know what the meaning, if it's social security.
It's a chronic illness benefit. So if you're unable to perform 2 out of 6 activities of daily living or have a severe cognitive impairment, it would trigger access to the death benefit while you're alive. Or if you were to have a critical illness, some things like a diagnosis of cancer, for instance, which is pretty common, right, in today's day and age, or a heart attack or stroke, which, heart disease and is the #1 leading cause of death. So if something like that were to happen, you'd have access again to the death benefit for an event or for some type of long-term care event.
Right. So let's talk, that's great. Let's talk about the actual life insurance, the different types of life insurance that folks can get into. There's, we're not going to go into real in depth. This is just more geared toward retirement, but there's whole life, there's index life, there's variable life. And I'm sure most folks out there don't know or what that actually means. So why don't, if you could just expand on what whole life means, index, universal life, and variable life.
Okay. So all 3 of the things you mentioned, whole life, variable, universal life, index, universal life, are all set up to be permanent life solutions, right? These are plans that the idea is that when you set them up, it is not an if, but a when will they pay out a death benefit. And the retirement component of them, right, is set up to be something, again, that is permanent or long lasting, something you will keep with you throughout your life.
Right.
The difference between them is in the funding, not the funding, but the actual investment piece inside of the policy, right? So with a variable universal life, the policyholder shoulders all of the risk of the investment, right? So you're purchasing in a separate account. You're purchasing, either mutual funds or ETFs, bonds, etc., right? Equity-based type of holdings, inside of the policy. And at that point, those outside separate accounts are either making interest based on returns of the underlying investments, or they're losing money based on those underlying investments. And so, the performance of that particular policy and what your income would look like in the future, should it be set up for you to receive income in the future, are based on those underlying sub-accounts, right? Now, from there, kind of the middle of the road, or kind of between, I would say, whole life and variable universal life, is index universal life, right? And the index universal life is where the insurance company is giving you some kind of underlying guarantee, right? Whether that is a 0% floor, right? So they're using an index such as the S&P 500, or they're using some type of outside other index. It may be, based on the Russell or the NASDAQ, or could be, some type of other index that they've put together.
Different stock market indexes, right?
Correct. But ultimately, they're giving you some kind of cap or floor. So they're guaranteeing maybe against loss, or they're giving you some form of underlying guarantee, maybe 2.5% minimum guarantee contractually. And then they're giving you the upside potential of that index based on performance of that index. So the idea is that, you have the opportunity to earn a better than fixed rate of return, right? Better than, say, what the fixed rate of return is available out there in the marketplace, but without shouldering all of the downside risk that equities and underlying investments and sub-accounts would expose you to. So it's for those individuals who are looking for upside opportunity, and they want to participate in some of that, but without shouldering all of the risk of the loss and the pullbacks in those equity positions. Right. And then third, you've got whole life, right? And the whole life is, the interest is generated or paid by typically by a dividend, which is declared by the insurance company, and that's supported by the insurance company's profits and other investments through, things like treasuries and bonds, etc. That the insurance company uses to make up their general account. And so in that particular situation, it is a declared annual dividend, and that is what the client receives on an annual basis for participating in the plan. So it's, it's not quite that simple, but if you're taking you're backing up and looking at it big picture, they're all three ultimately designed to be permanent solutions, and they all mechanically will allow for you to accumulate money in the plans on a tax deferred basis, and for you to take, withdrawals in the future, policy loans in the future, so that you can provide yourself, your family, with an income stream for supplemental income in retirement on a go forward. And it's really, I think it's up to the client and advisor to review the different options and come up with the one that, that suits their risk profile and what they're trying to accomplish.
That's exactly what I was going to talk about, risk profile. Whole life, someone who's conservative says, I don't want to lose a penny. That's what I discussed. Someone who's more of a moderate investor, which is, I would think, most of the people out there in the world, index would be a good solution. Someone who has a higher risk tolerance and understands markets, doesn't want to be capped on the upside, then you have the variable solution, where they know markets perform, they understand that markets go down, they go up, but historically they average, pretty decent amounts depending on what decade you look at. That's how I position it. If you have a higher risk tolerance, you have the variable solution. You're a moderate investor, you have the index, and if you're very conservative and say, I don't want to lose a penny, you have the whole life. But let's talk about, so you mentioned policy loans and withdrawals.
If you don't mind, I just would like to add maybe one more thing to that.
Sure, go right ahead.
So I think what you're saying is 100% accurate when you talk about, risk tolerance or risk profile for the individual when talking about the product specifically. But I also think that the overall risk tolerance of the client, the client could be someone who is more not necessarily risk adverse, or it could be somebody who is more aggressive in their investment strategy, but they're looking to use something like an index universal life as a hedge against other equity positions, maybe as a bond alternative.
Right.
So just because you're someone who may think, well, I'm younger, or I'm in my 30s, 40s, or even 50s, and I still have a 20, 30, 40-year time horizon, so I have time to allow markets to work. Maybe that VUL is more of a fit for me. Well, I think it's important to look at your overall plan and to discuss
Right.
that with your planner, because you may have, something that is more moderate or something more conservative may be a better fit, right, to offset some of the other accounts that you have.
Yeah.
If you're looking to establish a 70-30, right, 70% equities, 30% kind of bond or bond alternatives, right, or
Right.
80-20, so on and so forth, it's really important, I think, to look at everything holistically and not to just look at things
Oh, of
individually.
course. Yeah. You position the solution for what the client goals are. That's
Right.
how what every planner advisor should do.
And so I wouldn't say you necessarily would shoehorn, hey, only conservative people do whole life, only aggressive people do VUL, only people in the middle do
Right.
IUL, right? I would say all of those people participate in all of those plans, dependent upon how their overall financial plan is set up with them
Right.
and their advisor.
The
Yep,
life insurance is part of their asset allocation. Yes,
you got
absolutely.
it. Yep.
Right. Okay. So policy loans and withdrawals, if you can go over the differentiating of what that means.
Sure. So
Well, let me
let's
skip
start with.
while we're going to distribution now. We're not even using this, but it's fine. We'll just keep it up.
It's all right. So, when talking about policy loans and withdrawals, with the insurance, that it comes down to taxes and trying to position the policies to where we can put money in the plan, have it grow on a tax deferred basis, and then access that money in a tax favored way. So, with a policy, when it is structured correctly to be non-MEC, for lack of a better term.
If we can, in just the modified endowment contracts, what that means in English is that, and again, correct me if I'm wrong, that there were a lot of wealthy folks before the MEC came around where we're stuffing a ton of money in life insurance for the tax deferral, and the IRS in their infinite wisdom said, whoa, wait a minute. You can't do that. We're going to put a maximum per year that you can put in, so then you can borrow against it. If you don't, if you put more than the maximum amount, we're going to tax you on the withdrawals. Correct?
Right. Basically, it was non-regulated to the point where I don't want to say that there was an infinite amount of funds that could be put into these policies, but they could, these families, these wealthy folks could put very large sums of money away, have the money grow tax deferred, and then take it tax free and never pay any taxes on it,
Right.
without any type of guidelines around the insurance. And so the government came in and said, well, look, this isn't an insurance policy at all. There is no component of insurance, right, affiliated with it. You've got $100,000 death benefit and you've got $1 million of cash in the policy, right?
Yeah,
So,
right.
they put some guidelines around that. So as long as we stay within the guidelines and the policy keeps its non-MEC status, right? The idea is the money can grow tax deferred and we can access it tax free. So basically, when you take a withdrawal, when it is a non-MEC, you take the basis out first, right? So you take the money that you've put in first. That's the money that comes out of the plan first. So that's a return of your principal. Like any type of account, if you're getting a return of your principal, there is no
Not
tax
taxable.
on a return of your principal. So with a non-MEC, we take withdrawals to basis. We're able to take the money that we put in without paying any tax, even though there are gains inside of the contract, right?
Okay.
And then from there, when we want to access the gains of the policy, right? Well, if we access gains in any type of account, well, the federal government says, wait a minute, right? You've made money here. You owe taxes on that money. So the policy loan then is where the insurance company will send you money from their general account, right? And they collateralize against your cash value in the policy. Therefore, your policy your money stays invested in the policy, and because it's not coming out of the policy, it is not taxable. But they're willing to send you their money from their general account, right? Because your money is there and it's collateralized. Then, when the person passes away, the death benefit pays the loan back, and the loan is forgiven, right? Therefore, you've been put yourself in a position to take all of the money plus all of the gains out of the plan and never pay any taxes on any of the gains in the contract. So that's what withdrawals to basis and then policy loans. And that's why, there are policy loans with these particular plans. It is a legal way for you to be able to access money from your policy, right, without having to pay tax on it. And that's, then you get into the types of policy loans that are out there. There are participating loans, there are variable rate loans, there are fixed rate loans, there are contractual zero cost loans, right? And so that's where you would kind of walk through what those different loan types are with the particular type of policy that you put together. And, David, that's where you would come in and kind of go through that with your client.
Right. And just a question for folks out there. Let's say they take out all their basis. Now they're borrowing from the gains. Do they have to make a payment against that? Okay.
No, they do not. Nope.
Good.
They never have to make a payment again, especially if they're in a contractual zero cost loan.
Okay. Excellent. So again, so you have the accumulation phase, the distribution phase. That's where, again, we're just mentioning discussing the life insurance is where you start taking the funds out of your life insurance and funding your retirement. So, and another way to look at this being tax-free, when I have folks who I work with who hate their RMDs, they don't need their RMDs, but they have to take them, right? Obviously, if you want to save inside, if you can put money into a Roth, fantastic. If that's not an option, you want the tax break up front. This is just another way that you can take your RMD and then not increase your taxable income. Because again, let's say you're in a taxable account and you're getting dividends and capital gains, whatever the case may be, and all of a sudden you have
rental income, Social Security income, all the different incomes,
everything that's coming in, and then all of a sudden now you have this other amount of income that you don't really need or want, but you're being forced to take. This is a good, again, as Hobee said, a hedge against that. So perfect. All right. So distribution phase. Anything else you want to add there?
Yeah, I think this is where a lot of the magic with using the life insurance planning comes in. And when I say magic, I just mean that this is the exciting part, right? Because again, we don't know what tax rates will be in the future. We don't know what types of income specifically that people will have. We don't know, at what levels dividends will be, income tax will be, cap gains taxes will be. We don't know if the Roth will continue to be tax-free. We know that, tax-free municipal bonds are tax-free, but they're provisionally taxable on our tax returns, meaning they can make other income taxable or taxable at a higher tax rate. So we don't know what future tax laws will hold, but what we do know is that, with the insurance, with these policy loans, that we're able to take those tax-free and it's not reportable on our tax return. So, when you think about things like Roth conversions, if all of my money that I'm receiving on an annual basis through my qualified plans and through Social Security and through rental income or whatever other types of income I have, if they're all coming from taxable sources, and I'm taking those distributions to live off of, and I say, I'd like to do some Roth conversions because maybe I'm, not going to use all of this money in my life. And that's the most favorable way to allow this money to accumulate and pass to the next generation, or to hold on to so that it's the last money we spend, so that the remaining spouse, who's going to go to a singles tax bracket once you have the death of one spouse overnight, right? They're going to jump into a higher tax bracket. So, hey, doing Roth conversions would be really great for the remaining spouse to be able to stay in a lower tax bracket later in life, right? Again, to afford them a higher standard of living and pay less taxes, meaning keeping more of their hard-earned money. Well, if all of your sources of income are taxable, you're never going to be in a position, right, to do Roth conversions at a lower tax bracket. So you go to do that. Let's say in our previous example where we said the first 100,000 was at 15% and the second 100,000 was at 25. Well, if a husband and wife have, call it $90,000 in income that they're living off of, and they're receiving all of that from taxable sources, and they speak to their advisor or their family or their kids or whoever, and they think, these Roth conversions make some sense, right? Well, if we start doing those conversions and it drives us into that 25% tax bracket, right? Now we have more of that money, both federal and state, leaving our hands and going to the government in the form of taxes. Where if we have a life insurance solution where we can access this money tax advantage and it's not taxable, now we can stop distributions from things like our IRAs, our old 401ks, and other taxable sources where we're choosing to take distributions from those accounts that are taxable. And now if all we have is our Social Security income, right, we may have a buffer between our Social Security and that next tax bracket that may be $40,000, $50,000, $60,000, $70,000, right, within that first 15% bracket, where we can do a Roth conversion and we can roll over 60 or 70,000, and we can do so at that lower tax bracket. Therefore, more of our shares reaching that Roth status, keeping more of our money. And we're only able to do that because we have a tax-free, non-reportable source that we can receive money from, right, and live off of that while we're making these conversions. So, without having that tax-free source or that life insurance policy where we can access those policy loans or withdrawals to basis so that we can live off of them with that tax-free, non-reportable income, you're just not in a position to be able to do that. So again, back to like the very beginning of our conversation, it's about flexibility. It's about maintaining control of where we're accessing these retirement distributions and what are the tax consequences of taking it from here versus here, right? How can we keep more of our money? Well, you can keep more of your money by having flexibility and control and having different places to be able to pull from that are in different tax classes for.
Got it. So in doing the Roth conversions, you're going to want to do that pre-RMD time, because it wouldn't make sense to do that and then you have to take a certain amount out. So it all goes back to planning, and that's my whole thing on why I'm doing this. Planning is so very important. No matter who you are, you got to have some type of plan. Engage a financial planner, have a discussion. Even in your 20s, it's never too early to start planning.
Agreed.
Excellent. All right. So what do we got? Protection. So now that we talked about, and I just want to go over, I know it's a protection product. It's insurance. Let's talk a little bit about the actual insurance that it gives. So let's say you set up a life insurance policy for retirement and God forbid something happens to you prior, you have this life insurance policy that you can, request tax-free to your heirs. But I'll let Mr. Hobee go over the protection aspect of the life insurance.
Yeah, so we'll start with the loss of a spouse, right? So again, to our earlier point, it's if I'm let's say I'm funding a Roth IRA, that's my tax-free portion of my retirement plan, or I'm funding my IRA or my 401k. Well, that's all well and good as long as I'm both physically able to work, right. And fund it, and or I'm physically here to be able to work, to be able to fund it.
Very important.
If I put $6,000 or $10,000 away, right, and then I pass away, but I'm 45 or 50 or 55 and I had 10 more earning years, right? Mm-hmm. How is my spouse going to retire if we weren't around, or we weren't physically able because we were incapacitated to be able to put that money away? So, I just say, look, if you put 6,000 or 10,000 away and you pass, or you become incapacitated, what do you got? 6 or 10,000.
10,000.
Right. If you have, the life insurance and it pays out the death benefit, you have the death benefit. So it has a self-completing component to it, right? You're getting, 3x, 5x, 10x, 100x, whatever it is based on the time and when that event were to occur. So again, hedging against an early loss or becoming incapacitated unexpectedly earlier in your career, right? Because chronic illness or a long-term illness is not just for old people, right? I mean, people have accidents, people get, disease and illness every day.
At any age,
We're not just 70 and 80 years old, right? Yeah. And then when you talk about, distributions and protecting that retirement nest egg. So I'll talk through just a quick example. if let's talk about 2022, right? I think, everyone, when you look at the math, pretty much across the board, I think 20% down, right? Markets
Right.
were down, call it 20% on average in 2022, plus or minus. So in a year that's the markets are down, if most of your retirement accounts are equities based, right, or market based, you own shares, right,
Mhm.
of companies within ETFs and mutual funds, etc. Or maybe the individual position, you own the individual stock itself, right?
Right.
And so when the market is down 20%, it doesn't mean you lost 20% of your shares. It means your share price went down 20%. You still own the same amount of shares of that individual entity.
Mhm.
So at that time, if I say, okay, well, I'm retired and I'm in distribution phase, right? And I need income to live. I can't
Mhm.
just decide, well, you know what, the market's down this year, so I don't need to live, right? I don't need to pay bills. I don't
Don't
want to
need to
go
eat.
and you don't need to eat, and I don't need to go out and see my grandkids, etc., and live my retirement years. No, I need income still, and I'm dependent upon those accounts to provide. So the worst thing that you could do in that situation, though, right, would be to take a distribution from an account where your
Mhm.
share price is down 20%.
Right.
Because now, let's say I need $10,000. Well, I have to sell more shares, right, to
Mhm.
get that $10,000 when my share price is depressed. Meaning that when they do turn around, whether that's 1 year, 2 year, 3 year, 4, however long it takes for that account to turn around, I now own less shares,
Right.
right? So it's reverse dollar cost averaging. And that is super detrimental, right, to longevity and that account being able to sustain and continue to pay you out that type of income long term without running out of money or having to substantially reduce the distributions that you're taking from those accounts.
Right.
So a better solution would be to have a life insurance, product in place like we've been speaking about, have it funded, have cash inside of it, right, that you're able to access through withdrawals and loans on a tax-free basis. And if you're using a product like an IUL, Index Universal Life, that has that 0% floor,
Mhm.
right, or some minimum guarantee, on the down years in the market, we don't take distributions from that account that the share price is down 20%, where we're forced to do reverse dollar
Mhm.
cost average and sell more of our assets. We let that hang out, right, and recover, right? We don't need to beat it up anymore. We let it
Right.
hang out and recover. What we do is we pull distributions from our IUL, from the insurance policy that had that zero floor, that didn't experience that 20% drawdown or pullback, right? And
Mhm.
therefore, when you look at it holistically, again, keeping more of your shares, having a higher probability and likelihood that you will not run out of money and that you will be able to continue to make the distributions that you had set out and planned for. So not only at that point are you putting yourself in a better tax position, where now that year and that down year, and you took maybe a larger percentage of your overall retirement income from your life insurance policy, well, that also means you have less taxable income,
Right.
right?
Right.
So that means you may be having, again, back to that buffer inside of that current tax bracket you're in. Without going to the next higher tax bracket, you might be also in a position that year to do a Roth conversion, right? And
Right.
so we can now do a Roth conversion and do it in that lower tax bracket and move more shares at a lower price, meaning getting more shares over into that Roth status for the same amount of taxation. So when it does return, now I have more shares in that Roth account. So kind of a win-win-win. So again, it's not just protecting you from a death or from being incapacitated or unable to perform 2 out of 6 activities a day living, but it's protecting your overall retirement account from outside unforeseen things like market pullbacks,
Mhm.
right? And from tax changes, etc., giving you again flexibility and control of where the money's coming from, and protecting you from all of these types of negative things that can happen to the rest of your retirement portfolio, which could put you in a bad situation later on in life.
Right. And there's also that goes to sequence of returns risk, which I'm going to
100%.
have. Yeah, I'm going to have risks to your retirement at another webinar. But sequence of returns, yes. I mean, you have folks who if they were set to retire in 2022 and they didn't rebalance their portfolio, their heavy equities, now they're taking, let's say, 3 to 4 or 5% withdrawal rate. Now they're down 20%, plus they're taking out now they're down 23, 24, 25%, which can be very detrimental in the longevity of your retirement, which I'll go over on another one. So
And
perfect.
if we had a, you know, even a smaller position inside of the index universal life that had taken a zero that year,
Mhm.
they'd be in a position to take that income, you know, just maybe in that single down year.
Right.
And not
And then
have
the
to.
next year they can turn off life insurance. Exactly. So that's the back
Thank
the
you.
flexibility. That's perfect. So back to where I had that wheel. There may be years where you may not need $200,000, right? You just don't need it. You're not going anywhere, or whatever the case may be. You have the option to say, okay, I'm not RMD age. I want to take from my tax tax preferred accounts this year. I don't take money out of my non-tax my taxable accounts, and then the following year flip flop that. So you have the flexibility to go back and forth if you want.
You know, look, one of the things that I always share with people is, look, no one wants to be a victim of the tax code, right?
No.
Right? No. You know,
I personally do not either.
right? People want to be in control of their financial future, right? And they want control as much as they can of what that looks like. And there are so many things we can't control in life, and we can't control in finance and economies, etc. If we can put ourselves in a position to have more flexibility, right, more access, right, more protection,
Mhm.
right, set ourselves up, hedge for being incapacitated or an early disability, etc., or an unexpected death, have access to money prior to 59 and a half without penalty, right?
Mhm.
I think all of those things, when the policy is structured and set up right by a financial professional, all of those things, when you put it all together, I think it helps people realize that, hey, having a life insurance solution within your overall financial plan, not your entire financial plan, right? It's not
Right.
your be all, but for
Right.
a portion of what you're putting away for supplemental retirement income, it's something that adds a lot of flexibility and protection and puts you in a position to where, you have more control of where you're at, regardless of the situation you end up with when you do get to that distribution phase, regardless of markets, the economy, taxes, etc. You're
Mhm.
better equipped to, to make decisions and moves and be more flexible and have more control of your money.
Right. And it's not just asset allocation, it's account allocation, right? You can have a traditional, you can have a Roth, you can have 401k, you can have a life insurance policy. And if you're funding all of them, you're going to have pretty solid retirement based on, what goals you have. Excellent. Mr. Hobie, this has been fantastic. Death benefit, living benefit, I think we already went over that. I've kept you here we're going on 50 minutes now. So I'm going to put a stop there. So thank you so very much for doing this. I really appreciate it. If there's folks out there that have any questions, I'm going to go back to the first screen with my information here. And again, I am your host, David Vigil, the principal here of Vigil Wealth Services. Please don't hesitate to get a hold of me. Hobie, thank you so very much for doing this, and you have yourself a great night.
You as well. Thanks so
Thank
much.
you.
Thank you, everyone.